Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Ryan Berkun, the founder and CEO of Teller. Now, Ryan's in the crypto space, and this goes pretty deep into crypto, so I wanted to, in the intro, give a little bit of an overview of some of the key terms for those who might be less familiar. So a couple things to keep in mind. Number one thing, we'll dive into blockchains. Blockchain is a concept of a public ledger versus a traditional private ledger where things are kept by a central authority, often a bank or credit union. The blockchain is a public ledger of assets and ownership. And it's usually verified by either proof of work, which is the traditional thing, what we call mining, where you solve hard math problems to stamp the blockchain's ledger, and then you're rewarded with some tokens, some value, and slowly shifting to proof of stake, where as opposed to solving hard math problems, you put up some tokens of the blockchain that you're staking in, and in return you get a yield, kind of a return for putting those tokens at risk, at stake, very similar to kind of lending or putting collateral out for a loan. On top of blockchains often are cryptocurrencies. These are the tokens that you're given. Most common ones here are Bitcoin and Ethereum, though there are many other blockchains and many other cryptocurrencies. Cryptocurrencies can be used as both a store of value. You can hold it similar to a security where it can go up and down in value, but ideally to hold value, and as a medium of exchange of transactions. So you can buy things, sell things, and exchange value in blockchain and in cryptocurrencies. Importantly, there's a type of cryptocurrency called a stable coin, which is generally pegged at 1-to-1 to a traditional fiat currency like the dollar. So USDC is a great example of a cryptocurrency that's pegged 1-to-1 to the dollar, which allows you to easily move in and out of US dollar or other currency denominated transactions and assets when you're doing transactions on the blockchain. Another kind of asset that's often stored on the blockchain is an NFT, or a non-fungible token, which is kind of validation of ownership of a digital asset, often an image. You'll hear the phrase PFP for profile picture, where you own an image that you then use for your profile picture online. The last concept I want to talk about is DeFi, or decentralized finance, which is really the concept of bringing traditional financial services onto the blockchain without a centralized player like a bank or a credit union. So lending or investing in a decentralized way where you can earn yield or borrow money. Today, most lending in DeFi and on the blockchain is over-collateralized. So people are lending cryptocurrency, but they're lending it with large amounts of collateral. Teller is really involved in this shift. That's what I would say, two things for the blockchain that are really important for the future and how it might interact with financial institutions. One, the shift away from highly over-collateralized loans to less or even uncollateralized loans being made on the blockchain. That's a huge shift. True lending, I would say, versus just kind of liquid lines of credit kind of thing. And the second is the ability to connect in a privacy-protected way real-world information like credit scores or identity to digital wallets or kind of digital identities that are on the blockchain. So I think it's really great conversation to delve into not only some of the fundamentals of cryptocurrency, but where this world is evolving and where it's going to intersect with the world of what the crypto folks call TradFi, but the traditional world of banking and credit unions, and kind of where that intersection is going to happen and what it's going to look like. So please enjoy this conversation with Ryan Berkun, the founder and CEO of Teller. Ryan, thanks for joining me on the podcast today. I really appreciate it.
Couldn't be more excited. Let's talk about DeFi. Let's talk about banking.
DeFi, banking, crypto. You are going to be the first of, I hope, many guests bringing not just a banking perspective, but new categories of banking adjacent or relevant content to the audience. So I'm really curious for the conversation today. But I would love to start off with just give me a little bit about who Teller is and what you guys do, since unlike a lot of my guests that are banks, it's not as easy to put into a box, I think, for most of my audience.
Absolutely. So when I got into the crypto space, there was such a big learning curve.
When was that?
This was
6 months ago?
3 months ago, getting into the NFT space.
Yeah.
This was around 2016, 2017, when I went down the rabbit hole and decided I wanted to be full-time in the cryptocurrency space. Took the blue pill. I was in the matrix, and I haven't looked back. It is the most exciting, invigorating space to be in, even when we have a downturn in a bear market, which 2018, 2019 was that for crypto. I had always been trying to figure out how we could bring mainstream into the cryptocurrency space. And I never got the feeling that an over-collateralized system was where that mainstream appeal would come from. I'm shocked by how much mainstream appeal NFTs have received, but I do believe that from a financial standpoint, The cryptocurrency space has an opportunity to revolutionize how digital assets are transferred and held and the transparency and openness of that. But we're going to see so many traditional like models, underwriting models, traditional like platforms for lending and borrowing that enter the space. So Teller is an unsecured lending marketplace. We are software that can connect borrowers and lenders where borrowers want an unsecured loan for any type of use case. It's almost like the underlying primitive. If you were to take the brand off of a bank or a lending institution, we replace that lending desk, the limit order book. And for us, it's completely transparent. So a borrower can say, I want a loan with these terms. I want a loan for X amount of dollars at Y%. And we do something really simple but powerful, which is allow the borrower to append a data signature. So they can append something that links out to any type of data that they want to apply to a loan. That could be credit information. That could be their employment information. That might be their Twitter profile. That might be their Uber driver data. Might be crypto native data. Anything that they want to append to a loan request that they want to submit. So now you have globally the opportunity for borrowers to say, I want a loan. Here are the terms I'm looking for. And here's the data I'm willing to showcase for this loan. And on the flip side, you have lenders in a normal marketplace like fashion that can look at any loan request that's been submitted. Just because a borrower asks for a loan does not mean it'll be filled, but lenders will, which borrowers do assume in DeFi today. In the state of over-collateralization, you assume as a borrower, I request a loan, it should be filled within seconds. But in a world where risk assessment matters, that likely won't be the case.
like normal banking, where there's real risk in play.
Yes. That's where the lenders can come in and say, hey, you now have this API to tap into where there's a global host of loans. Loans could be specific for personal lending. They could be different per jurisdiction in the States or abroad. They could be for auto, mortgage. The world is your oyster for figuring out what type of loans you want to lend into as a lender. And the markets are more competitive, naturally, because it's an open system where anyone could fight for these loans.
Let's back up a minute for those who have not fully taken the blue pill yet. I just watched the Matrix Revolutions or Resurrection with my kids, so I'm gonna make many Matrix references, I fear, today. But back up and just give me your take on the state of crypto / DeFi now, and kind of what you're seeing in that space and where you see the most mature. And then you've been using this word over-collateralized. So I really want you to go back and kind of give me the background on where lending on the blockchain is really at today.
Let's dive into it. So the whole initial purpose of crypto was to solve transparency from a technical side with digital assets. And that's what the Bitcoin white paper was meant to solve, where you could say that I own an asset and it's true. You can't prove or you can't falsify this information. You can't create a duplicate in the digital sense. And that takes the burden of trust from people, where currently the burden of trust in the US and in other jurisdictions is on people to print that money and moderate the money supply. With blockchain, you now have the trust, that burden of trust being on the smart contracts, being on the code. And that's the start of where DeFi comes along. To date, everything in crypto has been decentralized finance. It's figuring out how we can remove the people that have been at holding that burden of trust and replace it with code. So now you have digital assets like Bitcoin, like an Ethereum, that are commodities. They are something that everyone can buy, use, and hold. But as the space evolved, people started thinking, how do we get a unit of account on the blockchain? And that's where stablecoins arose. You have USDC, which is backed one-to-one to the US dollar. You have DAI, which is pegged to a basket of assets. And these different stable coins allow people to say, I really have a dollar-like index on chain. That's where DeFi started to flourish. So people thought, oh, if I have this stable unit of account, how do I make money on that? Well, the easiest thing you can make money on is an over-collateralized system. A world where if I am depositing some asset into a vault, I can borrow some amount of credit or cash against that asset. And if the asset depreciates in value, that asset will get liquidated, thus covering the entirety of my loan against that asset.
Okay, so this is really my understanding of over-collateralized lending on the blockchain now is kind of people who own a bunch of crypto maybe want to borrow in a stable coin, don't want to sell their assets, right? They think crypto, they still think Bitcoin's underpriced, Ethereum's underpriced in the long term. And they go, but I want some USD in the near term. They can borrow and basically put up their crypto as a collateral against the loan, usually over collateralized to what they're borrowing. Lender's safe, consumer, crypto owner gets USD or maybe a stable coin that they can, sell into USD, and everybody kind of walks away happy. But to your point, so do I have that roughly right? And that's the use case is typically people who actually have obviously some holdings in crypto that they can over collateralize the loan with. They're not borrowing beyond their current crypto
it's
assets.
Very similar to stocks. So if you had 10 million in stocks, there are institutions that will take those stocks and allow you to borrow against them. It's the same but principle here in crypto. But the question is, what is the demand for in these use cases? There's two things. One, the genuine demand of not selling my crypto and being able to use money in the short term. But actually a more prominent demand is to buy more crypto. Most people are borrowing over collateralized to buy more because they want to leverage. That's been the use cases. So really that next unlock for crypto is unsecured lending. It is places where there's actual risk involved, but we're able to offer value to the end user where they didn't have that value at the start.
That's fascinating. So how do you go from, in a world of, I think crypto is really fascinating because in the blockchain, if I have a wallet address, it's not really tied to a person, but I can see everything that wallet has done. NFTs they might own, crypto assets they hold. I mean, but as an owner, I probably have a couple. I've got a Coinbase account. I've got my MetaMask wallet. So I have at least a couple of different, homes for assets, if you will, in the crypto universe. How do you think about the challenges of moving to an unsecured world where you don't have some sort of identity tied to, a wallet? And if I think about a credit bureau, one of the beautiful things about it from a lender's point of view is it's supposed to be a collection of all the debt obligations. So I can go one place and see what you owe. And of course, in a world with multiple wallets, I can see what this one wallet's done, but maybe not what Jeff has done across all of his things. And I certainly think bankers are curious how you think about, overcoming that challenge in the context of crypto, because it does seem like the thing that you have to do to unlock a less typical use case, a less easy, like over collateralized use case, and get into actually like lending in the pure sense of people who don't have, access to the funds that they need in the near term, not just kind of a margin line or a liquid access line or something like that.
Crypto loves this idea of anonymity, just being fully anonymous, but that's not necessarily how the space will evolve. Even though people are anonymous, I think what we saw with the NFT craze of 2021 is people want to show themselves in some type of digitally native way. And that's where profile pictures as NFTs started becoming more and more popular. Identity will enter the space, but it won't be as outright as it is in the traditional form, in traditional finance. There's going to be this spectrum, this blend of identity. Identity could mean multiple wallets that you're combining. Identity could mean this NFT that's associated with some of your social accounts. But how we see unsecured lending starting to evolve is where you can underwrite. If you don't have the ability to underwrite and prove that if this user defaults, that they will be penalized, it's going to be difficult. You need some sort of reputation, and that's where this data part of Teller that I described initially or teased out comes into play. So the idea for us is not figuring out necessarily what that data looks like or what that identity is. It's allowing people to attach any identity that they want to attach. Something that's key for that is privacy and ownership of your data. This is how identity will transform in the Web3 standard. With Web2, the institutions or the platforms you're using, whether that's Google Cloud or AWS or Dropbox, that's where your data is. And when you share it with an institution, they also house your data. In Web3, you own your data. You own that NFT that you bought. You own your Ethereum in your wallet. That's how your identity will play out. And to enhance that, there are privacy solutions being built. So there are two projects that anyone in the audience could look at. One is called Chainlink. Chainlink is an oracle. So they're like an API for the blockchain industry. And they're working on a solution where they could privately prove certain data about an individual without revealing the original data. So they could privately say your credit score is above 750, true or false, without ever revealing the score. All you have to trust is that the algorithm was run, and you can do that cryptographically. So
Got it.
that's how privacy will be built in natively, and these users will be able to opt in to when they want to attach identity to these loans.
Interesting. Now I want to use the word oracle, and I'm going to give you my understanding of oracle, and I'd love if you tell me if I'm right or wrong. But I think of an oracle, as I understand it, as some sort of a connection between the blockchain world and the non-blockchain world. The simple example I always got is we make a smart contract, which is on chain. It's like a bet on the outcome of a basketball game. And we both put in the money. It says whoever wins, we're going to automatically withdraw the funds. But we got to know who won. And so the oracle is the thing that we can say we're going to rely on this conduit for the real world information, who won the basketball game we bet on, back to the blockchain to execute our contract or whatever. Do I have that roughly right? How do you think about oracles? They seem like a key component of what's needed to bring kind of a real world identity or a traditional credit history into a blockchain world.
Absolutely. So a blockchain can only read its own data. That's why it's limited. Every block that's produced, that block can look at any previous block, any data set. It's like an Excel spreadsheet. As you add more rows to the spreadsheet, it could look at previous rows. It cannot look at new rows. It has no way of looking at forward data that's not already in the database. That's where an oracle comes in. So an oracle comes in to say, okay, at the next row, I'm going to write some piece of information from the outside world. And then the block after that oracle enters their information will be able to use the info. So that new block is saying, oh, the oracle at 10 minutes ago said that the Spurs won the basketball game. Then there will be a payout event. Let's say it's a betting contract. There will be a payout event where the winner gets paid out. So that oracle is dependent. Absolutely.
So let me ask you two questions about this. One, on oracles, it seems like that's going to be a point of, if DeFi is about decentralized finance, we need some sort of trusted entities, it would seem to me, to run the oracles. They seem like a point where we're going to have some agreement on how we represent the real world, and do we trust that you didn't, if I took control of the oracle, I could win all my bets just by lying about who won games on. So is that going to be a point of somewhat centralization, or at least trusted organizations that are owning this kind of connectivity to the real world? How do you see that playing out?
It's going to be a spectrum. So on the DeFi native side, you can have, if the data is a commodity, it's easy to decentralize or mitigate the risk of any one actor tampering with the data. So with Chainlink, for price data, let's say it's Ethereum-based data, they have 20, 25 plus trusted node providers that are providing data into a singular data stream. And then the final output, which is the aggregate of all of these streams, is used. So if anyone shuts off or it's out of the standard deviation, they're just not included, and they don't get paid for that. So there are ways to mitigate risk from one sole party holding it. However, when it comes to credit and data that is not a commodity, it becomes more reliant on those institutions. So a question we get asked is, as credit is built on chain, will the TransUnion, the Equifaxes of the world be able to play in this ecosystem? And the answer is absolutely. They are data providers and data servicers at the core, and they will continue to provide that stamp of legitimacy for this data. So a simple walkthrough would be, if a user wants to apply for a loan at a blockchain level, and it's a personal loan, and they need their credit score, and they need to connect a bank account, they're going to go to TU, or in the back end, TU will just have the API, they'll enter their social security information. TU gives you the legitimate data. What will change is that TU will put a stamp of approval on it with some type of cryptographic native wallet. So let's say they take their Ethereum wallet address. You can sign messages without ever writing to the blockchain. And that means that you can cryptographically prove that whatever account or admin owns this wallet legitimately signed this information. So that's how the user will get their data in a crypto native way, and they'll be in charge of applying that data to the loan. So they'll aggregate the data, say, here's my information from TransUnion. Maybe they can make that private by going through something like Chainlink, their private Deco solution. They can then say, okay, yes, my score approved by TransUnion legitimately was above this number. That's all they're saying to the public. And they're also saying maybe something about their banking information or their income. All that data gets compiled, and the user would go to something like Teller, or they would be going to an interface that any market owner would have that has Teller integrated as an API. So they might be going to Bank of America, and Bank of America could be submitting to Teller. They might be going to a neobank. That neobank is submitting the loan to Teller as an underlying infrastructure marketplace. Then you have lenders on the other side that will look at the data, underwrite it, and fill those loans.
All right, I want to ask you about a couple more concepts just so we can, for the audience, kind of help them understand. Number one, one of the things I hear a lot about that's really interesting, and I've seen some work going on around securitizations or other things, is this concept of a smart contract. So help me understand kind of what, if I think of a contract, pen and paper, I've signed many in my day, some with this very pen, what does a smart contract look like, and how and why is it different than a more traditional contract just by having moved it to the blockchain?
It's fun that the industry called them smart contracts for the reason it's fun to say, but they're actually logic statements. So a smart contract is the
it's very different. I have a very different concept when you say logic statement than when you say smart contract.
They are not like a business related contract where verbiage matters. They are if-then statements with simplistic functions on how money can update a database or how changes can update a database of money. So an analogy to this would be like a vault at a bank. And a vault at a bank has a certain passcode. And if you know that passcode, the function will say open. That would be the result of the function. So that's the same analogy as a smart contract. It has very rudimentary if-then business logic that can change things on a database if the right parties are signing off on that change. What is useful about a smart contract that's on Ethereum is that an Ethereum smart contract can act as a holder of money. So unlike the Bitcoin blockchain, where only the wallet owners, so I have to own a wallet, you have to own a wallet for there to be money in my wallet, the Ethereum blockchain said you can have a user wallet where I own it or you own it, or you can have a development or market wallet, and that's the smart contract. It's almost like a vault at a bank. So that smart contract, instead of being owned by the people at the bank, it's owned by code. And the code might say that no one is the owner of the smart contract. It only works on basic if-then logic. Or it might say the owner of the smart contract may be able to upgrade the parameters or settings of these functions for this vault. And that's how over-collateralized lending started. You were able to say, I have an asset in one hand, and there is this vault, this smart contract at this other place. I want to lend in. So the smart contract will have a lend function. And all it's doing is updating the database to say, minus that token from my wallet, plus that token at the vault. Tokens in the vault. Great. Now I can make money.
Now the contract owns your collateral, so to speak.
Yes, exactly. So it's if-then statements. It's a little bit more than just a legal contract. It can do things.
But it can, like, for instance, automate the over-collateralized loan.
Correct.
You can say, I gave the contract my collateral. When loan is paid back from this wallet to that wallet, give me my collateral back.
Yep,
If it's not, keep my collateral and send it to the lender. If I don't pay them back in a specified time frame, they get the collateral over here. So you can kind of automate that process, is my understanding, through the smart contract, versus having to go onto the chain and say, hey, I want to do something. Ryan didn't pay me back. What do I do now? Like it can be automated.
Exactly. And that is easy for the over-collateralized world. So that's why the world of putting an asset in a smart contract and borrowing against it made so much sense. Where this becomes more real world-esque or more traditional is with unsecured lending, where you might have someone like TransUnion be able to ding a FICO score if there's a default. You might have more traditional rails to monitor the activity and reputation.
I imagine as lending goes on chain, I don't have, no offense to TransUnion, I don't have to call them to see if your particular wallet has repaid loans or not. Theoretically, that's right there on the chain for me to view. And I imagine there's a world in which even non-chain lending could be represented on chain, repayment history, things like that, without having to be intermediated through a bureau or some third party.
That's what's going to be fun about this, and I think interesting for underwriters. You can see everything. So in the blockchain space, there's a concept of a decentralized identity, or a DID for short. And this is an aggregation of everything that you as a user want to tie into an identity. So we're going to see that pseudo-anonymity evolve over time, where you took out loans in the blockchain space, but you also had loans coming into the space. Maybe it is beneficial for you to append all the loans you've taken out in the traditional space because it gives you some type of better
I've got good credit history. I want credit for it here on the blockchain.
Exactly.
Okay. How are there ways? I think one of the big questions I've always had is, are there ways to bring some of that information in a way that I can control who sees it? Because of course, there's the nice thing about like the universal ledger. I don't have to prove to you that it's true. It's there. On the flip side, I don't really want my credit file visible to the world, right? Like if you go to a totally DeFi world, all my payments and transactions and the information, my plaid transactions for maybe income verification, my depository account transactions that you're talking about providing to a lender, I kind of don't mind them being on chain if they're not, for transactional purposes, to be able to share them to people via a blockchain mechanism. But I don't really want everybody who can download the chain to like see my whole history. What is the state of having information that's connected to an identity in DeFi, invisible to some parties, but not totally public in a way that kind of, I think, violates the privacy expectations that most consumers would have in the end about some amount of their private financial information?
Yeah, it's early. It's early in development, but it is being worked on. And there are two scenarios that this model can showcase. The first is what I described earlier. There's technology called a zero-knowledge proof.
Zero-knowledge proof.
Zero knowledge.
Seems counterintuitive. Zero knowledge proof.
I'm proving that I didn't know something. I didn't know the actual information, but I'm proving that the result was true, was correct.
Okay. So give me an example of that so I can wrap my head around it.
It is the idea that we have a zero knowledge proof. It's just a function that says, is your credit score above a preset number?
Okay.
Just if you think of in JavaScript, function, enter credit number, and then prove out the result, true or false. Mm-hmm. That is a very basic way where the user on their end, so not on a bank's end, not on the chain, can say, I'm submitting my official score from a TransUnion, and the zero knowledge proof is going to showcase to the world that I have a proof. The function really ran. It did its job. I'm not tampering with it, and my score is above a certain number.
Interesting. And would it be possible for, like, let's say a lender to have a function like credit score that was more their own underwriting, that they would not necessarily see the underlying data that was in the file, but was able to see the loss prediction or whatever it was the output, and they go, this really ran, it really ran on Jeff's credit file. I can't show you the file, but I can tell you what the outcome of the function you've defined is. That sounds like that's what you're describing.
Yes, we are so excited about that model because then users are truly in control of the process and they own their data. So it will be easier for those models to happen from a pre-approval level, where the pre-approval is this more out-of-the-box solution that the user can run. There is computational limitations to it, but in theory, this will happen, where you have some type of out-of-the-box underwriting model for pre-approval, and the user runs it at their home, on their laptop, and they get pre-approved, or they get some type of underwriting complete. That underwriting they can append to the loan. Now, the question begins when the lender or the underwriter needs to see more information, which they might. At that point, there will likely be more closed-off pools where lenders have to be KYC'd. They need some type of regulation or licensing to be able to see more information. And users would be able to dictate which lenders would they like to share their information with. What's cool is that on-chain, you will get a hash of the data. So on-chain, you could say, I will prove to the world that the data is really this data. No one is getting different data. As a lender, you'll see all the public information, and you could compile it as well to get the same hash to make sure the data adds up to what they're submitting. However, no one will be able to see the data except who the user shares it with. And that's how there's an off-chain world of real data, selectively shared, but an on-chain world where you don't know anything about this wallet. All you know is they took out a loan, maybe they repaid it, maybe they defaulted.
Interesting. So you're able to share selectively private information, validated on chain, but the data itself only visible to certain parties. That feels like a really interesting space in terms of enabling the kinds of transactions most of us would expect with a financial institution. All right, interesting. When you said a few things, I'm cognizant we don't have infinite time, but you've talked about NFTs. For those who are not familiar, can you explain what an NFT is? And then you mentioned profile pics. And so, like, talk to me a little bit about the history of NFTs and how they came into being, and should I be buying multi-million-dollar NFTs, which seem to be an asset category people are interested in these days.
DYOR, do your own research. Yes, the Bored Apes have gone up to insane levels. They're the cool kids club. So are the punks. NFTs are a simple idea that we can go from a token that holds value on chain, so a digital native token that you can't duplicate, to saying, what if we replace the idea that it's currency with any type of data? So I can say, as the creator of the data, in the banking terms or in the credit world, this could be the originator of a credit score. I'm the originator of a credit score, and I'm going to put my stamp of legitimacy to say this credit score came from me. Everyone else that tries to copy it is a fake. It's a phony. There's a stamp of approval. A non-fungible token is saying that this data that's not fungible, it's not reproducible, there's a unique piece of data, unique credit score for everyone out there, can be tokenized. You can have a digital representation of it that proves the authenticity of it. And then after I tokenize it, you don't need to rely on me or keep pinging me as an API provider. I was just the originator of the data. So that's how the NFT started generating interest, because you can append any type of data and prove that it came from the legitimate source. It's just like if you had a Gucci bag, you want to prove it came from the legitimate source. It came from Gucci, the company.
Yeah. My wife can tell the difference. She looks at the patterns, but I can't tell the difference.
We couldn't tell them. I couldn't
But
tell them.
the blockchain can tell the difference.
On chain, Ethereum can tell the difference. You can't fool the blockchain. And that's why NFTs are valuable. They started gaining popularity as images. It is more to fit into a culture rather than to value the artwork at the start. It's to understand that this technology proves I genuinely am a part of this club. And that's why when I talk about Bored Apes, it's more of a social club.
This is the Bored Ape Yacht Club, like one of the first big popular NFTs. In my understanding, when you say profile pictures, people are making mine's a headshot, my picture in Twitter or LinkedIn, but people are using these. They're making NFTs that are images that are used for the purposes of being profile pictures, kind of to your point, as a club membership card. But I also understand some are now using it as a actual membership card where owners of these NFTs are getting access to real world events, real world activities. They're actually like a legitimate club, have activities or events or services are only available to people who own an NFT from a certain creator.
Yes, NFTs are going to have so many cool use cases. The reason being, most assets that we purchase outside of stocks or cash are non-fungible. They're natively non-fungible assets, and we've never had a way to authenticate or monetize them in the digital sense. So, example is exclusive access. During NFT NYC, the Bored Ape Yacht Club community actually hosted private events where you needed to own this NFT to be a part of the club.
Were they on a yacht? Was it like a Bored Ape
Yacht? One of them
club?
was on a yacht.
Of course it was.
Another was a on-stage party. I think they had Chris Rock. They had a bunch of other just performers come on. And you needed a Bored Ape. And people who didn't have one were starting to have fear of missing out. And they want to join the club.
Yeah, for the listeners, I will say this feels to me like a bubble. No offense, but the like Bored Ape Yacht Club buying a yacht with or renting a yacht with Chris Rock feels like a bubble. But I think of it as the Gartner hype cycle, which is the kind of at the peak of the hype is the early stages of real adoption and the utilization. And then you've got, I feel coming the trough of disillusionment, where it feels like, I think Bored Apes are trading for hundreds of thousands of dollars, if not millions of dollars now for an image. And they're interesting, but they're not exactly, classic art.
That's how we feel the use case of NFTs will expand. I'm most excited about when they can represent title from the traditional world. That will be title to a loan, where you can have secondary markets of loans with NFTs being the vehicle. There'll be title to a mortgage. So many exciting use cases from.
There was this interesting. I don't really want to get into DAOs now because I think we'll run out of time. But there was an interesting organization set up whose goal was to raise money on chain to buy a copy of the Constitution DAO. I'm sure you're familiar, Ryan, because I figure if it's in crypto and I know it, you got to know it. But there was this really interesting question of how the on-chain wallets could ultimately have any actual ownership of a physical object. There was no legal precedent for how an on-chain ownership represented ownership in some off-chain real-world property and I would put a loan or any kind of traditional financial asset into that category. Have you seen people bridging that gap? That feels like it's going to be a really interesting moment when there is a verifiable on-chain way to say that this wallet address owns this thing that's not just a piece of data in a database, but is an actual, connects to the ability to sue or take ownership in the real world of a possession.
Oh, this is coming. Have you looked into the Wyoming DAO laws?
I have not looked into the Wyoming DAO laws. I will admit to being behind the times in this area.
Wyoming has put out the first laws surrounding a DAO and how you could launch a DAO. A DAO for Wyoming is like an LLC. However, the governing rules, you no longer need a piece of paper where you sign and have official members. The governing rules are based on smart contracts. So you can actually point to a smart contract that has all of its logic built into it for governing. And that DAO also functions as a legal LLC. So that legal LLC could go out to hire someone to buy something. Own property. It could own land. There is a project called City DAO that has pioneered this. One of the applications for it is that they actually have gone out to buy land in Wyoming, and you as a token holder have one of many voting rights on what happens with the assets owned by the LLC. So it's almost like combining a co-op with general like C Corp corporate structure, where everyone who owns a stake in this can vote, but there still needs to be some type of management that connects it to the physical world.
Yeah, I think that connectivity would be very interesting. For those who aren't as familiar, can you just explain briefly the concept of a DAO? And I'm not sure we totally want to dive into DAOs, but if we're going to talk about Wyoming DAO law, we should talk about what a DAO is. But I think it's fascinating that a DAO could be both an on-chain entity and represented as an off-chain entity in the form of an LLC. So it could have on-chain votes or contracts that might be representative of real properties or items or objects, which is just a fascinating conversion there.
So a DAO is a decentralized autonomous organization. It is a crypto terminology that became popular. It represents the ability for a collective group of people to own some share in governing some treasury or some amount of assets. The easiest way to think of it is like a co-op where many members control the stake or where this boat will go. Very similar to owning public stock and the ability to vote on the board. But instead of the board, you're actually voting on use of funds in treasury. So you're helping make managerial decisions. That brings everyone involved. And what that's allowing is fractionalization. So if you were to buy a multi-million-dollar property or maybe the most expensive property in Manhattan, maybe you individually might not be able to afford it, but you want upside in it. You want the ability to have some stake. A DAO is a really good way to facilitate that, where you have a legal entity. That legal entity can now pool money together. Every dollar that gets put in represents that percentage of share divided by the total amount of dollars that have been contributed. So you have that fractionalized percentage ownership. And you can vote on what happens with the property that the DAO buys. You can vote on whether you want to liquidate that property.
Well, so I want to ask you one question on this, and then I want to wrap up with a little advice for you. But like, convince me or help me understand why this isn't going to look like a really bad version of my HOA. Like I have, a handful of people voting in my HOA. It's hard to get anybody to agree on anything. And now you're talking about multiplying that and putting real financial weight behind there. I mean, is there a reason to think that this is not going to become mired in, awful voting procedures and back in politics and all the stuff that the real world, voting mechanisms end up in for things like, a homeowners association or a condo building or something like that. It feels really interesting, but it also feels like there's some real challenges in terms of management and structure and how we ultimately get. Man, I think every CEO is out here is going, please don't have my vote board on every budget decision I have to make. Like, okay, good God, that sounds awful. And then multiply my board from 10 or 15 people to, 10,000, and they're all voting on my budget choices or my hiring decisions. Like that feels like a nightmare. Why am I misreading that? Am I misreading that? Are there places where it makes sense? Like, why should I not be as scared of that as my gut reaction is?
It depends where the DAO comes into play. To date, there are problems with voting. Voting has a lot of attrition to it. Not every token holder votes. If you get more than 20% of the token holders voting, that's a miracle. Like it's a great feat. So with that being said, DAOs come into play when there's a final product. If you're talking about a software company, a DAO makes more sense to govern the product itself. And that's where DeFi is heading as a product space. All the products in DeFi are open source. So ownership, collective community ownership is very important because that builds a moat around the product. And an example is Compound Finance. Another is Uniswap Finance. Both these products have decentralized autonomous organizations where you as a token holder can vote on the settings of the project, of the actual code. So with Compound, you can say, I want a new token to be added to this over-collateralized lending software. And by voting, the smart contract will actually add that token if everyone approves it. It's automatic. It's a way for products to evolve with community ownership without centralized management. The same thing can apply if we're thinking of land or thinking of real estate because it's already a final product. However, as DAOs evolve, we're going to see a model where the DAO more acts as a pool of money, and then it directs money to centralized companies that are not governed by some crazy number of 100,000 people that get to vote on decisions.
People talking about startups being replaced by DAOs, and I went, I've been a part of a startup now, and like, you know, decision by committee is not the way you make generally lots of progress in the early days of a product. But there are certainly, I can see use cases for that kind of control voting, or, you know, something like a fund, and where we want to invest in an angel investing fund would make a ton of sense to have in this kind of structure.
Yes.
So I wanted to kind of end. I usually ask for history of advice in different areas for my guests, but I kind of want to get your take on, you know, my sense is to really understand DeFi, crypto, Web3. You can't just read about it or listen to it, you know, all the great podcasts aside, but like you got to do it. So what's your advice on for those listeners who are saying, hey, this stuff is interesting. I feel like it's going to be relevant to me sometime. How do I get a better handle on it? Where can I go out and like, where do I buy an NFT or look at this stuff or a smart contract? Like, how do I start, you know, dipping my toe in the water so I can understand it a little bit better with a hands-on experience? What's your advice on where to go and do that? And then tell us a little bit about any way they can get involved in actually, you know, testing the Teller platform and what you guys are building.
For anyone getting into DeFi, you need to play with it. It is too confusing to simply read white papers or listen to podcasts. Once you interact with the technology, you will feel the power of its transparency. So the first thing you need is assets that allow you to transact on the blockchain itself.
That's a good start. There you go.
It's very different from logging in with Gmail. There is no login with Gmail. So you need Ethereum if you want to play on the Ethereum blockchain. To save gas costs, you could use a layer 2, which is a layer of a blockchain built on top of Ethereum, or something called a sidechain like Polygon. So you could go to a platform like Arbitrum or Polygon, and I'd recommend using an app like Aave.com, I believe. They allow you to do over-collateralized borrowing and lending. So very easy.
Yeah. What was you say? What's a good on-ramp? Like, tell me how I could have done better. I'll put it this way. I onboarded myself through something like Coinbase just to like take my USD and own Ethereum, because I've got to get somebody who can actually, from whom I can buy, you know, my stuff. I moved it to a MetaMask wallet, and then I was able to use my MetaMask experience to log into Aave or other things. Yeah. Is that a good route? Like, you got to, you know, get the crypto asset in something like Coinbase. Most people, I think, are familiar with Coinbase, and use something like MetaMask as my holding place to then go and interact with different Compound or Aave or other places that I can go and try and actually partake in these kind of ecosystems.
That is the best onboarding. Okay. I would.
Paul, good job. Paul Gu, our co-founder, gave me that route. So Paul, Ryan says you did good.
Paul did great. Buy ETH on Coinbase, transfer the ETH, or if you want to use Polygon, buy Matic on Coinbase. The coin of Polygon is called Matic. And then you'll send it to MetaMask. So once you send it to MetaMask, it will be natively yours. You will have custody of it. Coinbase custodies the asset on your behalf. Once it's in MetaMask, it's your token. Now that you're on the Ethereum network, you have a choice of using Ethereum, and you can go to compound.finance. You can go to aave.com. You can deposit that Ethereum into any of these platforms, and then you'll be able to use that Ethereum, borrow against it, borrow a stable coin or an asset against it. And the steps may feel confusing or unnatural because you have to sign every transaction you do. Unlike an application in the traditional financial world, there's not only buttons that you go to the next page. You have to sign with your wallet a transaction that is proving that you are legitimately doing this action. Then as the money moves, you'll notice that Ethereum is actually being depleted from your account because it's being spent on the fees needed to make that action on your behalf.
Yes. And talk to me a little bit about the fees. I think they're called gas fees. And I find them a little ironic because I remember the original, when Bitcoin was in 2012 or 2013, 2014, when I first started hearing about stuff, there was this like, we're going to have microfinance and micro payments and everything is going to be cheap. And it feels like the gas fees on a lot of these blockchains aren't small. The kind of fee added to pay for the processing of the blockchain seems to be quite high. Is that a long-term challenge for crypto? And are there ways I can, like times of day or things I can do to avoid paying? Like, I think some people pay like $200 to just deposit $100 into the Constitution DAO to buy the Constitution. That seems silly. So are there, where do you think about the state and the future of gas fees as people get into there? Be aware that it's going to cost you something to do this right now while the fees are there.
Absolutely. And this is why I would recommend looking at other layers outside of Ethereum for your initial go at this. It will cost a couple $100s to make a transaction on Ethereum. And that's because there are scalability costs. Ethereum is upgrading to a new proof of stake network. Currently, they are proof of work. So it should be cheaper. It should be more scalable. However, with that being said, it's just the more bandwidth, the more network demand there is, the more concentrated the demand on the bandwidth is, and the higher the price. Gas fees are a function of demand and bandwidth. So I would recommend looking at Arbitrum or Polygon. These are two.
Arbitrum and Polygon. Okay, I'm going to have to check those out. Anything else I should check out? I know the most popular NFT, if you want to go buy yourself a Bored Ape, you can go look for them on OpenSea, although I don't think they're very available. But if you want to kind of look at what buying an NFT looks like and owning a piece of art, I minted one, so you can try and find the NFT I made. But is OpenSea the best place to go? That's a place I'm always referred to in terms of an NFT marketplace to see what's out there and buy or sell items.
OpenSea is the eBay of NFTs. That is your one-stop shop. If you want to buy an NFT, you want to experiment in the space, definitely head over to OpenSea to buy your first one.
All right. Anybody wants to go bid on my fabulous piece of artwork as an NFT? I think it's currently valued at something like $2. I don't know how they came up with that price, but I'd part with it for the right number of Ethereum if anybody out there wants to check it out. But
it's selling for 10 ETH.
That's right. It's 10 ETH. 10 ETH, it's yours. I give you a free recreation if you want it for 10 ETH. What that's trading for now. But I will say I highly recommend that for anyone who's curious about this space. In my wife's medical school class, I always said, see one, do one, teach one. I feel like that applies here. I learn more every time I try to play with it. And I learned even more when my son, who you'll love this, Ryan, follows Dogecoin. He's always asking me what the price of Dogecoin is. The only thing he has in his stock tipper app, he's got a Mac, and his stock ticker app only has Dogecoin, which he follows for reasons I don't fully understand. But you kind of doing it teaches you a lot, and then trying to explain it to someone who is less in it than even you are, I feel like helps even more. So I highly recommend getting your hands on. Ryan, is there anything people can do to interact with what you guys have at Teller? If people are kind of curious what's going on, what can they do to check out where you guys are at? 'Cause I think you're at a really interesting place for a banker interested in crypto in terms of moving away from this highly over-collateralized, smart contract-based lending for people who have a lot of assets in crypto into a more unsecured, something that looks like maybe what the future of real banking in crypto could be.
Absolutely. Follow us on Twitter. We are at UseTeller. Head over to teller.finance so you can play with our V1. Our V1 allowed users to deposit assets in an unsecured manner. Those assets would be locked up and used in escrow. So our initial version was very DeFi native. Coming soon will be an application that will feel a lot more familiar. Will feel more like a limit order book and something that really could be integrated into a bank today and a place where you'd be able to lend out to those type of more traditional loan requests.
Got it. And then I will ask you my one traditional final question, Ryan, which is give me a bold prediction about the future. You feel like you're in a space that lends itself well to bold predictions about the future. But if I want to call you back in a year and tell you were right or you were wrong, what's one bold prediction for us about what's coming over the next 12 months?
You are going to see, in the next 12 months, you are going to see financial institutions begin adopting DeFi in a serious way, where DeFi isn't their front and center. It's actually something that blends into the back-end infrastructure. Just like we saw PayPal and other major financial technology companies cross the line for digital assets, you will see the same in the next year with institutions.
institutions on DeFi in the back end in the next 12 months. All right. I look forward to hearing from those institutions in response to this podcast. Ryan, I appreciate your time. Thanks so much for joining me. It's been a fascinating delve into crypto, and I appreciate your taking us down the rabbit hole.
I loved it. Thank you so much for having me, Jeff.